How to save your assets for your family comes down to understanding documents and taxes. And that's the topic of today's video, estate preservation. You might be surprised to learn that the beneficiary designation is actually the most powerful document at time of death. A beneficiary designation will overpower what a trust says, and a beneficiary designation will overpower what a will says. Truly, the beneficiary designation is the most powerful document, so you want to make sure you get it right. There's some common mistakes that folks make when doing beneficiary designations, and there's really a best practice. Now, the best practice is to name your beneficiaries by name, birth date, and social security number. Now, you might think that's a bit intrusive if you're naming a friend or a nephew to find out what their social security number is, but it's actually very important because if you've got the name, birth date, and social security number of a beneficiary, they can divorce or marry or relocate, and there's no confusion as to who we're talking about. Also, it allows you to bypass probate, have those assets get sent directly to the beneficiary. More about that in the second half of this video, where we talk about the taxes at time of death. So there's some common mistakes that people make when doing beneficiary designations. The first mistake that they make is they leave a beneficiary designation blank, and they believe that their will control the situation. That is not correct. A blank beneficiary designation often is with an investment provider or an insurance company that has what they call a default beneficiary designation in place. There will be some type of custodial agreement or plan document or insurance contract that says if no beneficiaries are listed, then we will assign a default beneficiary as follows: surviving spouse, 100%. If no surviving spouse, surviving children. If no surviving children, surviving parents. If no surviving parents, then it escheats to the state. In other words, it gets paid to the state, it goes into the treasury, and they sit on it until they find a justified claimant has come by to claim it, has done all the paperwork. So having a blank beneficiary designation can be a nightmare if you don't want to have that type of handling of your estate. Now, other folks will say, I've got that covered, Matt. I'm going to name my estate as my beneficiary. And what you've really done is you've volunteered to sit in a traffic jam rather than take the shortcut. The beneficiary designation, when you have somebody listed by name, birth date, and SOCH, is like a shortcut where it just goes directly to them. But saying my beneficiary is my estate means that now it's controlled by the will. It's going to go through the courthouse, attorneys are going to be involved, and you've delayed the process by at least several weeks, if not several months or longer. And you've probably added an unnecessary 5% expense to the collection, accounting, and distribution of that asset. So do not say my beneficiary is my estate. Another mistake that people make when naming beneficiaries is they'll name beneficiaries by relationship. What I mean here is something like, my beneficiaries are my living, legal, lawful children. Well, now your kids have to prove in a court of law that they're your kids and that nobody else is. Some young couples will do this because they're not sure how many kids they're going to have. But once you know how many kids you're going to have, you really want to take the time to list them out by name, birth date, and SOCH. The final mistake that a lot of people make on their beneficiary designations is they set it and forget it. An example would be a man who lists his parents as beneficiaries before he gets married. After he gets married and creates a will, he thinks, well, the will says she gets everything and we're married, so she gets everything. And that's not the case. If he predeceases her, everything's going to try to go up to his mother and father. And if his mother and father have predeceased him, well, then everything is going to go down to his mother and father's heirs, which would be his siblings, most specifically his sister. So even though he has a wife, and even though he's named her in the will as his sole heir, the asset, because it has listed mom and dad as beneficiary, will actually go over here instead to his sister. So that is a big mistake. Another big mistake we'll see is folks get divorced and they leave their ex-spouses on as beneficiary. Now, oftentimes this is done on purpose shortly after a divorce because the assets had been commingled for so long, it just makes sense. But after many years down the road, and there's been possibly some remarriages, and now the assets are being handled differently, it no longer makes sense. So too often, folks will have their parents as beneficiary even after they're married, or they'll have their former spouses as beneficiary even after they're remarried. So those are some common mistakes that folks make when it comes to beneficiary designations. Another mistake, but it's not your fault, but you're the one who pays for it, is oftentimes beneficiary designations will get lost. Now, it's not under all circumstances when I say oftentimes. It's when there's a merger or an acquisition. There's been a lot of consolidation in the banking industry where banks will change names every couple years. And if they should happen to lose your account number or your balance or your name and birth date and soc, they'll spend an unlimited amount of time and money finding it in cyberspace and getting it reattached back to your account. But we've seen many situations where the beneficiary designations get lost and they consider it an acceptable loss of data. They'll say, well, they'll be in someday and update it. So if your bank has changed names, what I would suggest is give it a couple of weeks and then go in and redo all your beneficiary designations over from scratch. Don't say, well, what do you have on file? Because they'll be a little bit panicked looking for it. Just go in and say you want to fill out new beneficiary forms. And if the new ones exactly copy the old ones and they still have the old ones on file, no harm done, but it was worth the extra effort. Next, let's talk about trusts. Trusts are the next most powerful document at time of death in how to handle assets when they get distributed. So a trust is really a pretty simple concept, but there's been a lot of misinformation about trusts and what they are and how they work. The best way to think of a trust is it's like a pocketbook that holds assets. So rather than having this asset or this money in your pocket, which is on your person and you own it directly, you have it in this pocketbook, the pocketbook being the trust. So if you think about our other video of the tax control triangle, I said IRAs are like bags into which you place investments. Well, a trust is like a pocketbook into which you place assets and investments. Now, when it comes to trusts, there's two basic types. There's irrevocable and revocable. Now, a revocable trust is something that you can change, that you can cash out in its entirety, that you can overfund or underfund. These trusts are very comfortable for folks because of the flexibility. Sometimes they're called living trusts, or sometimes both words are put together, revocable living trust. Now, a revocable living trust uses your own Social Security number in generating a tax ID number for the trust. So it's one and the same. And that's an important thing to keep in mind. A revocable living trust is the same as you. So you're not getting any special creditor protection as a result of that. Now, the reason why someone might want to do a revocable living trust is to have control over the distribution of assets after their time of death. So let's say you have a child that's special needs, or a grandchild that's special needs. Maybe they have some cognitive impairment, or maybe they just have really bad spending habits. If you want to put some restrictions based on how that money gets spent at time of death, and you want those restrictions to be subjective, meaning you want somebody to make the decision as to whether or not this is an appropriate use of money, that's where a revocable living trust can come in. Another reason why someone might want to have a revocable living trust is to own real estate that's in a state other than the state that they live in. So if you have real estate up north and down south, you probably want to have a revocable living trust to hold that real estate in the state where the family doesn't live. The reason for that is so that you do not have to open up probate in that estate and go through the process in the courthouse with the attorneys. So a revocable living trust is not separate from you, so it doesn't get any special creditor protections, but it can be used to distribute assets according to your wishes, subjectively, and it can be a good technique for holding assets. Now, the other type of trust is known as an irrevocable trust. An irrevocable trust has a tax ID number that's separate from you. It has its own EIN, or employer identification number, if you will. This type of trust is considered something separate from you. Therefore, it is no longer your asset. It's no longer something that creditors can impinge upon if you should find yourself in financial duress. The irrevocable trust is a very powerful tool in estate planning because it will preserve that money no matter what happens to the donor, the person who set up the trust, during their lifetime. The donor could find themselves needing long-term care and spend many, many years in a nursing home, which can bankrupt some of the largest estates, but that money is still protected and preserved if you've created an irrevocable trust in which to hold those assets. So the thing to keep in mind with trusts is they are like a pocketbook. The irrevocable trust is separate from you and has creditor protection, files its own tax return, has its own tax ID number. The revocable trust is not separate from you. It goes on your tax return and uses your Social Security number and does not have any additional creditor protections. But keep in mind, all trusts are overwritten by all beneficiary designations. So make sure your beneficiary designations are correct. The weakest of all the estate planning documents is the will. A will gets overwritten by what a trust says, and a trust gets overwritten by what a beneficiary designation says. And of course, a beneficiary designation will override a will as well. So it doesn't really matter what your will says in regards to a particular asset if there's a trust owning it or if there's a beneficiary designation already on file for that asset. Those will overshadow the will. But nonetheless, the will is important. In my opinion, the most important thing about the will is the naming of the executor if it's a man, or executrix if it's a woman. This is the person who's in charge at time of death. They are the boss. They interact with all of the utility companies, all of the investment providers, all of the banks, all of the other heirs and beneficiaries to make sure that everything gets processed and taken care of. They're the boss, they're in charge. So the naming of the executor or executrix is really, quite frankly, in my opinion, the most important part of a will. There's some things to look for and some things to look out for in regards to a will. One of the things that you want to look for is that a will is signed by witnesses. One of the challenges with this, though, is the witnesses could be asked to appear in the courthouse to verify that, yes, that's their signature and that they witnessed this will and that you were not under any duress or cognitive impairment at the time when you did this. That can be rather challenging. If your witnesses' signatures look like mine, they're probably pretty unreadable as well. So it's important to add an extra page to the end of the will. It's an affidavit which self-proves the will. And what that means is the witnesses sign an extra page at the end saying if they're not able to appear in court, this extra document, this extra page at the end, will appear in court on behalf of them to validate this will. So having a will that's self-proving, that's got this extra page, this extra affidavit at the end, is actually very important to simplify the estate planning process and to speed things along. Now, something to look out for in a will, it's a mistake that I see far too often, which is people think that the will is where they list individual assets. My 18th century sideboard goes to my son. My mother's anniversary ring goes to my daughter. Those are the types of things that you do not want to put in a will. The reason being is the will is a public document. This gets filed at the courthouse, and it's available to whoever wants to see. Now the problem is, when these assets are listed in the will, they become part of the probatable estate, which means they have to be appraised, and then whatever your state inheritance tax is gets assessed upon the appraised values of those items. So what you're really doing is you're listing a bunch of things that you have that you think are of value that you're asking the government to tax on your heir's behalf. So you do not want to list individual assets in a will. Also, this prevents a lot of people from doing a will because they're not sure who they want the individual assets to go to, or they'll change their mind over time. That's why naming the executor is so important, because really you want to leave that type of stuff up to the executor. Let the executor handle that and make those decisions. Now you might be saying to yourself, well, my executor would be so-and-so and they wouldn't know how I would feel. So what you do is you write a letter of instruction to that executor, telling them what your wishes are. So the letter of instruction, it can be holographic, you can write it in your own hand, you can type it up, but you do not want to attach it physically to the will, because now it becomes part of the will. I've even been advised by our certified elder law attorney that we have on retainer that you should not sign it either. You should just initial it and date it. And over time, as you add to your assets or dispose of assets or feel differently, you can draw a single line through the person who's receiving it and put the new person's name down and initial and date next to that. Or if you've sold the asset, you can draw a line through that asset and just make a note with an initial and a date that you sold it. So that's a letter of instruction. So the types of things that are best handled in a letter of instruction are antiques, jewelry, silverware, cars, guitars. You really don't want to handle real estate or anything large like that. Car is really about the largest thing you'd want to handle. And if it's a particularly valuable car, well then maybe you still want to go ahead and put that in the will anyway. But any of the smaller household items, hand tools, all that type of stuff is really best handled in the letter of instruction. One of the strong points of a will is that you can control assets after you're gone. But that's not the only way that you can control assets after you're gone. You can do this using what's known as a restricted beneficiary designation. A restricted beneficiary designation applies some type of formula to your beneficiaries on how quickly they are allowed to withdraw money. Now, it does not apply any type of judgment, like this money can be used for college but not a car purchase. It's simply a formula like you can withdraw 20% per year over 5 years until the account's liquidated, or you can only take a withdrawal based on your remaining years of life expectancy. So a restricted beneficiary designation is kind of like a trust, but without the expense of the law firm or without the complexity that goes into a trust. Also, trusts are taxed at a higher rate than individuals are. So if you can control the assets the way you want them to be controlled after time of death using a restricted beneficiary designation, that's a better way to do it. Now, not everything can have a beneficiary on it, and not everything that can have a beneficiary on it can have a restricted beneficiary. Typically, whether or not you can do a restricted beneficiary depends upon the actual investment provider or insurance company themselves. Some will allow you to do it, some won't. Some companies will advertise that they do this, and some companies will do it only if you ask for it. So if you'd like to learn more, there's a couple of things you could do. You could subscribe to our YouTube channel, or better still, just pick up the phone and give us a call. We'd be happy to talk to you.